everybody, and welcome to the Dash Trader Newsroom. This is the second quarter earnings wrap-up. Welcome to the Dash Trader Newsroom. My name is Michael DeJoy. I'm the Director of Educational Services here at Dash Trader and a licensed professional. So good to be here today with you. A lot going on here as earnings season wraps up. We have yet another bank, another regional bank, on the verge of collapse, or maybe just losing 10% of its deposits. But PacWest Bank has lost about 10% today in the markets. Now, it is down already quite considerably after it really got negatively affected by the failure of Silicon Valley Bank and First Republic. And now it looks to be the next bank that is kind of teetering on the brink of bank failure. And the question is whether this will continue. There's about 3 or 4 other banks that are in similar states of, somewhat financial uncertainty. And the big question is PacWest going to be the next regional bank to fail? So on that note, and to be honest with you, from my analysis, we had a recent 25 basis point rate hike by the Federal Reserve. And although things do seem to be slightly better than they were about a month or two ago when the bank crisis started, we have a number of banks that are still having financial difficulty. And just by the nature of the interest rates going up, we have a situation where a lot of the assets that the banks hold are actually devaluing. So not only are the deposits less, but the actual assets at the bank are worth less and are actually in losses, because as the interest rates go up, the treasury notes that the banks hold to kind of secure the deposits, most banks hold treasury notes. And as the interest rates go up, the face value of the treasury note goes down. And what you have is the deposits in the bank are what secure the bank's ability to lend money and actually secure additional capital and to do all kinds of normal bank operations and bank investments. Now, in the case of PacWest, we have kind of a double whammy going on here, because we have depositors also being afraid that the bank might fail. They're withdrawing their deposits. And not only is the bank dealing with the normal reduction of the face value of those treasury notes, but they're also losing the underlying deposits, which is why they bought the treasury notes to begin with. So this is exactly what happened to First Republic. First Republic was teetering on the brink, and then they got us some short-term help. And then within about a month and a half, that short-term help was no longer enough, and then the bank was assumed control. The bank was assumed by the Federal Reserve, and then pretty much auctioned off to J.P. Morgan Chase at a deep discount. With all that being said, you could see the little image here of of kind of the banks losing deposits. People are starting to get worried that there will be additional bank failures. PacWest mainly has branches up in the Pacific Northwest. That's like Oregon and Washington State, as well as some in Northern California. So it doesn't seem like the banking crisis is over just yet. So we're going to stay tuned, and we'll check back on that one in about 2 weeks. All right. Well, we got Disney. Mickey Mouse is looking a little depressed at the moment as Disney shares sink. Me personally, this is about when I usually cancel my subscription to Disney Plus, as there's no more episodes of The Mandalorian coming out, and Baby Yoda is quite the draw these days for Disney, and people are going into summertime now. Earnings and revenues met expectations, but traders and investors view the streaming service as the main metric for growth for Disney. And like I said, it's summertime in the Northeast. It's pretty much summertime across most of the United States. So as people gear up for summer, they're saying, oh my God, inflation's going up. Prices of food are going up. What can I cut? and maybe Disney Plus, since we're going to be going to Disney World or Disneyland, or maybe we're just going on summer vacation and the kids aren't going to be watching too much TV as the weather warms up and we're going to try to get out of the house. So we actually saw Disney Plus subscriptions drop, which was a pretty significant loss from the way that traders and investors viewed it. And Disney stock was down pretty considerably on that news. 10% is a massive drop for Disney. So certainly that has, weighed on the stock and probably will continue to weigh on the stock because we're just in May. And June is pretty much the real start of summer in the Northeast and the Pacific Northwest. So we will see as the summer marches on, if we see this trend to continue. So you may see another down quarter for Disney's streaming service. Now, with that being said, the reason the earnings and the revenue were doing fine is because what increases as you go into May and June? People get off from school, they go to the park. So the park revenue certainly made up for the loss of subscription services. In fact, the streaming subscription service narrowed its overall operating loss to about $400 million. But again, most of the revenue in Disney was made from its traditional services like parks and other entertainment related services. So that's why Disney met on earnings and revenue, but lost subscribers. Anyway, perception makes reality. That's what we know about in the stock market. People perceive the streaming service as the key metric for growth, and therefore that was what they were focused on, and therefore the stock was down pretty considerably on that news. All right, jumping right along to J.P. Morgan's Jamie Dimon warns that U.S. sovereign debt default is a real problem. Like we didn't already know that. Good one there, Jamie, for pointing out the obvious. I guess that's a Captain Obvious kind of situation. Needless to say, this is what he said. The closer we get to it, you will have panic in the form of stock market volatility and upheaval in treasuries. And this upheaval in treasuries is exactly what I was talking about with with the possibility of the continuation of the bank crisis. So as the treasuries continue in fact, as the interest rates continue to go up, the face value of the treasuries go down, which further worsens the banking crisis. But the Federal Reserve is actually stuck between a rock and a hard place, meaning that in order to fight inflation, they need to continue to raise interest rates or at least pause them, but not reverse the course. The stock market has been going up because it's been expecting a pause. However, the Federal Reserve cannot reverse. Maybe they can pause, or they can certainly continue at this measured pace of a 25 basis point rate hike. But just today, the Bank of England also raised their interest rates another 25 basis points, as England has a much worse economic situation than the United States due to Brexit and a number of other important factors. But needless to say, you're going to see a continuation of rate hikes as the money that was pumped into the system during the pandemic needs to be pulled out somewhat. Inflation is still a problem. The CPI number this week did come in slightly lower than expected, but basically we're running at 4.9% inflation year over year. Now, what does that mean? Last year we were running at about 8% inflation. Now, 8% inflation plus an additional 5% or 4.9% is we're getting close to, and I think the year before that we even had inflationary pressures. That's 4.9% is still higher than the 2%, which is considered normal, natural inflationary levels for the Federal Reserve. So we're still a whole 3 points higher. And let's see what month it's in. We're in May. Okay, we usually say sell in May and go away. You have normal selling pressure in the stock markets in May, just because people take their investments and their risk off the table before they go away on summer vacation. As a result of that, we're probably going to see a lot more market volatility. Now, it may hold off until August and September. meaning that you have a lot of different inflows and outflows going on generally in summertime. But the reality is that we have a number of key factors on the wall of worry. Number one, you have the potentiality of the continuation of another bank failure, PacWest Bank or one of the other top 5 regional banks that are all on the wall of worry. Number two, you have the possibility of a sovereign debt crisis. Number three, okay, you have the debt ceiling potentially going to shut down the federal government. We have all kinds of immigration issues down at the border. We have the continuing war in Ukraine, which has been on the wall of worry for some time. We have the possibility of heightened inflationary concerns or the return of inflation. So there's a lot of things popping up on the wall of worry, and certainly Jamie Dimon has been one of the key major bank CEOs that has repeatedly said that we might be kind of teetering on the brink or on the edge of a financial tsunami if one of these items on the wall of worry turn out to be worse than expected, or really just kind of trigger the domino effect. One knocks over the other. And another one on the wall of worry is the commercial real estate potential disaster. A lot of commercial real estate is falling behind on payments as retailers have closed due to online competition. So needless to say, we have a lot of problems, on the horizon. And Jamie Dimon has certainly pointed out that the U.S. Government should certainly negotiate a deal so that we continue to pay our debt, because it does put the entire financial system at risk. And I don't want to be too gloom and doom. Again, I'm just kind of pointing out the key factors that Jamie Dimon, mentioned as things that we really need to rectify if we want to continue to keep the economy afloat. I don't want to talk too much about that negativity, but moving right along, we're going to jump right into our market analysis section. And let's see if I can transfer over to my Dash Trader, the Dash Trader charts here, and go through some of the key market statistics. So here I'm projecting my Dash Trader. We got the first one I'm going to go through is the SPY. This is the S&P. We're kind of stuck in a range here. You got a little double bottom, you got a high, a higher high, and then a lower high. And from here, it looks like we've kind of experienced some major resistance. Now, the market really could break out either way. This depends on, obviously, what happens in the news and the way the news is interpreted. But certainly, we've had a couple of attempts of the market to break down. We did put in a slightly higher low, and today is looking somewhat like a hammer, or it is possibly a hanging man, because of the way that it's sitting in this pattern overall. But needless to say, the market has been stuck in a range. We really haven't gone anywhere for 2 months. We did have a really nice rally up from the November lows. We made a big sell-off in December going into the end of 2022 and start of 2023. But pretty much 2023 has been a very flat, narrow range year. And that is something to just keep in mind, that so far this year has been pretty narrow ranged. So let's go to the QQQ. So technology has been doing a fair bit better. But if you notice that the doji-like bar that is at the top on the QQQ, a doji is usually an indication of reversal. We have a major resistance level at 335. So at 335, 332.50 to 335, we have a major resistance level. We have a high, a higher high, higher high. And then possibly this is somewhat of an indication of reversal on the Qs, which represents the main technology index. It's the NASDAQ 100. Let's take a look at the Dow, which is represented by the DIA. On the DIA, the markets are already looking slightly bearish. And certainly the DIA has a high and a lower high, and then we're kind of at the bottom of the range. An amazing close today. Just a very strange number, 333.33 on the DIA on the Dow. Very interesting. All threes today on the Dow, and very, very interesting closing figure. But certainly very, very consolidated, very sideways market. So far, we have not had a significant break to either the upside or the downside. But whichever way it breaks, that is most likely the direction that it's going to continue based on technical analysis. Let's jump right ahead because this one is pretty interesting. If I go to Goog is at a multi-month high. Google really riding on the back of AI. Wall Street is really, really enamored with artificial intelligence, and Google, being a leader in artificial intelligence, is way up there at a multi-month high. If I go to my weekly chart, you can see that the last time Google was at these levels was in August and September of 2021. So pretty much recovered the 2022 sell-off, but this is a very, very big area of resistance for Google, and certainly that is something to keep in mind. The other one that I want to keep an eye on is Meta. Meta is showing some signs. It made a big, huge run, had a good earnings report, but I think that Meta is showing signs of running out of steam. Meta is also coming into a multi-month high. I mean, tremendous run up. If you think that Meta ran from $90 up to $235, I mean, that's an incredible run. I would imagine that run is starting to show some signs of maturity. This has been a run from pretty much of November, October of last year, all the way till now. So we pretty much had a 7-month run in Meta. I would expect to see some distribution up here as people were trapped in some higher levels. And then, of course, obviously some people speculated, rightly so, and caught a nice ride to the upside with Meta. Another one to keep an eye on is certainly Apple, as they say today. So goes Apple, so goes the market. Apple coming right into our resistance level. Apple is coming right into horizontal resistance at the 173 number. And certainly I would keep an eye on Apple. This is a very, very indicative stock for the stock market. So certainly when Apple comes into resistance, and if it starts to reverse, this is exactly at resistance for Apple. So certainly keep an eye on Apple. USO, which is the oil contract, oil at many month lows, right? Oil kind of inverse of this picture, oil kind of on the decline. Again, this is because people are concerned that the world economy is slowing down. We have a financial crisis looming in Argentina, another item that's on the wall of worry. And certainly when the world economy starts to slow down, the demand overall for petroleum starts to slow down as well. So certainly that is something to keep an eye on. Now let's take a look at the old man, gold. Gold made a very, very multi-month run as well, and starting to slow down there on gold. In fact, gold is kind of here at the highs as well. Possibly gold might benefit. Gold has been benefiting from the weakness in the U.S. dollar, and certainly gold will continue to benefit if they continue to raise interest. Will continue to benefit if there's additional banking crisis. So it's a flight to safety in terms of gold, but also gold has already made a tremendous run. It's about a 7-month run, very similar to Facebook, Google, or Meta these days, Google, and certainly Apple as well. So these stocks have all kind of run to the upside, and this is probably a good time to take those profits in gold. Me and Jill have been speaking about gold for quite some time, and certainly that was a very, very good call to get into. Another one is GBTC, which is Bitcoin. Now, Bitcoin tends to sell off before technology sells off. And here you could see Bitcoin already selling off as represented by the GBTC. Here it is. You got a little bit of a shoulder, head and shoulder formation on GBTC running from 750 all the way up to 1750. And certainly we're kind of at the bottom at the neckline break area of GBTC and Bitcoin. So again, GBTC is just an ETF that represents Bitcoin. And therefore, I would say keep an eye on this one, because if GBTC starts to break down. Now, this is the one that I really wanted to talk about. It's the IWM, which is the Russell. The Russell is already broken down. It looks like a possible continuation to the downside. The Russell is the small cap index, Russell 2000 index. It has about 2,000 small and medium cap stocks. They are very interest rate sensitive. So as the Federal Reserve raises interest rates, these companies, which have a lot of debt on the books, have to pay more interest, and that hurts their operating capital. So certainly IWM is indicating that we're kind of coming into a pullback zone. Apple's at resistance. Meta is also at resistance. Google's at resistance. And we have all those items already aforementioned on the wall of worry. So technically, when you have fundamentals, we call this techno-fundamental analysis, when you have the technicals and the fundamentals showing that this is probably a good time to sell in May and go away and enjoy your summer with some peace of mind, maybe you should listen to those indications. And these are all indicators. That doesn't mean this has to happen. It just means that the market is saying that there's a lot of things on the wall of worry, and the charts are now confirming it. Not yet in Apple, not yet in Google, but they are at resistance. So if they don't break out and they try again, if you try to break through a wall 1, 2, 3, 4 times in a row, what happens? You say maybe the wall's too solid. I got to go back and get a bigger hammer, or it's just time to go back down for a little while and conserve my strength. So just think about it like that. There's a lot of items on the wall of worry, and we might be ready for a little break. So let me go back to our presentation. I got some very good and interesting news for us to share with you. So on July 17th, we have live training at the NASDAQ. This is a live training at the NASDAQ market site with closing bell ceremony. I'm going to be teaching anybody who wants to learn how to use their DAS like a professional, from a professional, learn how to configure your DAS Trader platform with me live at the NASDAQ market site. Not only will you learn to use the intricacies of DAS Trader, but you'll also gain trading experience and how to use DAS for trading from me at the NASDAQ. And seating is extremely limited. It's right in New York City in the middle of summer. Join me at the crossroads of the world in Times Square. We'll love to have you join me for this event. Get a light breakfast at 8:30. We go through scalping, gap trading, intraday trading, swing trading, options trading using your DAS Trader platform. We break for lunch at 12, and then we come back from 1 p.m. to 3:30. We're going to be setting up hotkeys using the script editor, configuring the trade signal, as well as other advanced features. Then obviously we have the closing bell ceremony, which is really an amazing life experience event. And then finally from there, I will take you out for some cocktails if you want to go to experience some of the finer side of New York City, and in some of the surrounding rooftops and various restaurants in Times Square. Anyway, I really want to extend an invitation, a gracious invitation to those who want to join me for this VIP once a year event at the NASDAQ market site. And certainly it'll be a great opportunity to learn about your DAS Trader, hone your trading skills. This is good for beginners, advanced traders, you name it. It's limited to 20 people, so seating is very limited. And I can't wait to have you. Make sure you sign up soon, because the early bird discount will be ending. And again, seating is very limited. So make sure you stay up to date with all things DAS by signing up to our monthly newsletter and email. Simply fill out the form at the bottom of the website at www.dastrader.com. Subscribe to our YouTube channel, DAS Trader TV, and our DAS Trader Newsroom reminders. Follow us on DAS Trader. You can follow us at LinkedIn, Twitter, Facebook, and Instagram. Thank you so much. I want to wish all the mothers out there a very happy Mother's Day. And everybody, if everybody's got a mother, make sure you remember her. Have a wonderful weekend. God bless. Trade well, everybody.